Good evening, and thank you for joining us. My name is Spencer LeClaire, and I'm Vice President at IA Clarington Investments. IA Clarington has partnered with both Corey and Mike at Eagle Wealth Counsel to provide you with valuable insights to questions that might keep you up at night regarding your retirement portfolios. Corey is with us on the call today, but he wanted me to introduce our very special guest, Sebastian McMahon. Sebastian is our senior economist and portfolio manager of diversified funds at our parent company, IA Financial Group. He has over 15 years of experience at a variety of leading financial firms, and his team currently manages about $8 billion in assets. Today, Sebastian will offer his insights on topics such as the current state of the global economy, COVID-19 trends which may affect your investments, and the potential market impact of the upcoming US election, just to name a few. If you have any questions, there will be an opportunity for Q&A after our presentation. Please feel free to write your questions down in the chat box below, as microphones are being muted during the call to prevent noise. And thank you for joining us, Sebastian. Over to you.
Yeah, sure. Thank you. Hello, everyone. So it's great to meet you then virtually. I am here in Quebec City tonight, so it's a very warm night. It's a great night to be discussing what's going on in the world and the market. So as you've probably seen, my cat is a big talker, and he likes to be in the spotlight. So maybe he'll be joining us at some point in this discussion tonight. So economy and financial markets, just to give you an idea of what's going on in the world right now. And if you have any questions, don't hesitate to ask them as we are going along, but of course we need to discuss the COVID situation. We are clearly in the second wave of new cases. Number of deaths are not following so far. It's more the young folks that are hurting now. We are seeing a second wave clearly here in Europe. So in Europe, we are seeing almost as many cases now as in the US. So they're having pretty bad now in Europe. In Spain, especially, is one of the hot spots. In France, also the same thing. In the US, one could argue that it's still the first wave that was never really under control. So we're still seeing many new cases there. In Canada, we are seeing an uptick in cases. We are not back yet to where we were in March, but especially in Quebec, where I live, we're having pretty much as many cases now as some of the worst parts of the spring, probably because the schools have reopened. This is one of the most important vectors. So as long as the hospital system is not overwhelmed, we should be good. The thing is that governments around the world have mentioned many times that now they don't want to close the economy again. So it's the really important thing for an investor to understand that you won't see a closing of the global economy, Canadian economy, US economy, as we saw earlier. And in fact, this analysis here from the OECD. So OECD, of course, they work hand in hand with the global governments around the world. And they used to have a pretty dire forecast in the fall, in the spring. Now they changed their forecast in the fall, and it's much better. It used to be that when we would reach the end of Q3, there would be like a path, like a W here. If we did have a second wave, we would have closures of global economies, and we would be back to where we were on an activity level. Now they changed their tune. They are, of course, working, as I mentioned, hand in hand with the global governments. Just a minute here. My cat is again playing tricks. So they are working hand in hand with governments, and governments are saying that, no, we won't be closing the economy again. We will be closing some specific sectors and putting some restrictions. So the good news is that the downside scenario, which is this line here, it used to be a huge W before a very slow grind. And now the worst case that we could see is that pretty much we're going sideways for a while. So of course, this is only a forecast, but this is from the OECD, and they work closely with governments. So this is what's expected. So we can see that as some good news. The bad news is that the upside scenario is not too far from the downside scenario. So there's not much disparity here. So however you turn it, you spice it, you'll see growth that will be below potential for a while. And before we get back to even the level of activity that we had in late 2019, it'll take until 2022, maybe 2023. So we're in for some higher unemployment than before for a while, and we're here. The economy will need some more support from central banks and from governments for a while. So of course the deficits are elevated. In Canada, we have lots of room to spare for that. We've learned today from the Throne speech that there will be more fiscal support. You need to have the right kind of support, but you still need to have some support by governments going forward, and you need easy money in this environment, so central banks will be on the sidelines for a while. So I'll be discussing that in a few minutes. But the news recently have been pretty good. So this chart here is pretty simple, even if it looks complicated. It's a surprise index. It's a Citigroup, which is a US bank. What they do is they look at all of the forecasts by economists for all of the data points, the economic data points that are published out there. And they look at if it beats or if it's below expectations, and they build a surprise index. So the advanced economies, as you can see, the surprises have been as good as they have been. If I went all the way to 2000, the year 2000, this would have been still the highest value in 20 years. So the surprises are actually very good around the world. So maybe the forecasts were a bit too grim. So that's part of that, but also the economic data has actually been pretty good compared to expectations. So we've had a very good run, but the easy part probably is behind us. Now we're getting into the harder part where the easy gains have been made, and now some job losses that were expected to be temporary are becoming permanent. So we're seeing that more and more, especially in the States. In Canada, we still have some policies that are keeping the employment link between employer and employee, but in the US, we're starting to see businesses shut down, and you're starting to see job losses that become permanent. So now these people have to relocate to find a new job. Maybe the businesses don't exist anymore. So there's this kind of friction that will be in for a while. And this is something that will be keeping this recovery in slow motion for a while until we get to 2022, 2023, when probably we will get back to the levels that we were at it before. Emerging economies were still beating the expectation, but not as much as in advanced countries, because governments in advanced countries have put so much money on the table to kickstart this recovery. This kind of recession that we're seeing is causing is hurting some groups more than others, so it's creating some more inequalities in the economy. So this is also a headwind for growth when you have inequalities in there. And if you look on the left, you have the change in employment by weekly earnings. So those that earn very little were actually the hardest hit. So those were the ones that lost most of their jobs. And as you can see, it's minus 40% in employment between February and April. So those that are low wages in services, those that are more vulnerable were actually harder hit. So this is creating problems. So that's why government stepped in quite heavily on that. We would argue that pretty much for certain measures, governments were a bit too generous, in the sense that they are creating some problems in the fact that some people were better off not working than working, because the programs were quite generous. But we're starting to see the end of these programs coming in, and the incentive to work starting to come back. So we'll see if we created some structural damage or not. But we did create some inequalities and some misery in the population. And on the right, it's women. Of course, women, the mothers, were the ones that decided to stay at home to take care of the kids. So this was the reality for them. And also the services sectors, like in restaurants and in hotels, lots of the staff that are in close proximity to clients are women, so they were hit a little bit harder. So it's creating some inequalities and some challenges for the government. So this is just the economic reality of it, and this is why we need some policies to support these persons that lost their jobs, because not the economy is going to be taking care of them. It's the government that needs to step in this kind of situation. central banks, so very, very low interest rates and easy money. That's how you tend to support the economy when you're a central bank in a recession. Here you have the Fed that mentioned last week that they will be keeping rates at the bottom until the recovery, and this is their quote, is very far along. So that means pretty much until 2023, maybe 2024, interest rates will be staying at these levels. So what that means is that you'll be seeing lots of impulse in housing because it's easy to borrow. Interest rates are low. In the economy, housing will be, as I mentioned, the most important aspect. But in the markets, when interest rates are so low, it's not as attractive to hold bonds. So when you're an investor, it's an environment where even if you have a shorter time horizon, maybe you're about to retire, you're just retired, you need to hold a bit more equity than you would have had in the past because the interest rate will not really cover for inflation. So you have a negative interest rate and a negative real returns on bonds. So you need to have more equities in your portfolio or more alternative investments in your portfolio. So that forces a change in the asset mix or the portfolios of investors. So this will stay true for many years. And pretty much just you can draw a parallel with 2009 to 2014, 15, where even if you saw some real risks in the economy, remember that in the US, there was a downgrade of the US economy. You had a second dip recession in Europe. So you had all of these risks coming in. People were saying, well, there are some real risks out there, but equities still did well. Well, it's because interest rates are so low that what are you going to do? You can't really, even if you buy bonds, you won't be able to get a good return out of it. So you might as well buy equities, and there's a rotation. You can buy defensive equities, more aggressive ones, dividend payers. So there's always something in equities that you can buy when you have such low interest rates. So this is a very important vector for investors and for us as portfolio managers. Very easy monetary policy. That means you need to have more risk in your portfolio, and it will always look more risky than it actually is because bonds are not really helping you here get returns. So talking about markets in general, this is as at August 31st. Of course, we're seeing a mini correction now in the S&P 500, which is actually a pretty good thing to see. There was some exuberance in the market, especially on the NASDAQ and all of the tech stocks. You're seeing, in fact, as of early September, the NASDAQ was having one of its best years ever. And this is even taking into account the fact that we had a bear market at the beginning of the year. So it was still its best year ever with 40-something% in early September. Now I just checked on my Bloomberg before starting this, and we're still up about 24% on the NASDAQ as of today, even if we did have a bit of a correction recently. And now the S&P 500 is still in positive territory tonight by about % or so, but at some point at the end of August we were up at 10% on the year. So look, the gray bar on the left is the return for the first quarter, and the other one is for the year as of August. So that's quite a turnaround that we've had in equities. Also, the TSX is lagging a little bit. Europe is lagging a little bit, but we will argue that going forward, these would be the markets to favor. They are quite cheap on a relative basis compared to the S&P 500, and we are seeing lots of issues with the U.S. economy and U.S. elections. I'll be getting into that in a few minutes. So the U.S. stock market is always one to consider. It's going underweight the U.S. stock market for too long could be dangerous. But if you want to be deeper into equities, favoring Canada and favoring Europe would be a good bet. On the right, you have the fastest recovery from following a bear market. So the pink line is what we saw in the S&P 500 from February to August, so a fall of about 35%, and we went back to a neutral or pretty much zero return year to date in 126 trading days. So that's much quicker than the fastest ones that we've had before the recoveries. So of course, easy money explains a lot of it. Fiscal support, explains a lot of it. So when it goes this fast, usually some consolidation is a good news to have a good base for the next phase, and this is what we are seeing right now. So investors are looking at the markets now. They're seeing the second wave hit Europe. They're seeing the election risk in the US. So there are some risks out there, and this is why we are seeing a bit of some profit taking. It's a rotation under the hood now in the S&P 500, but it's not surprising that we had such a short bear market and such a quick recovery. This is a chart that we've used for a while. This is from April. And it did tell us that when you have a bear market, so a correction of 20% plus, that is event driven. It's not because of the structure of the banking system, just like in 2008. It's not because of oil, like in the 70s, and the OPEC saying changing the way that they operate their model. It's a very specific event. Well, usually you decline a bit less than during a structural decline. So this is where this is history starting in the 1800s. So less of a decline, it lasts for less time, and it takes much less time to recover. So of course this time was lightning fast, but still usually those tend to rebound pretty quickly. So history warned us that those are usually short-lived, and this one was especially short-lived. But the risks are real now, so you'll be seeing lots of volatility going forward. Even if I tell you that you need to have more equities in your portfolio, you need to learn to live with this volatility. There are a few sources until the election. After the election, probably the smoke clears a little bit. There's always the issue about the vaccine, but no one knows when it's going to come, but probably it will be somewhere in 2021. The market always looks forward. So after the election, I would argue that you could see the market rally into year end. But before the election, now we know that, and this is as of last week, September 17, Mr. Biden, here, the Electoral College in the US, you need 270 seats to win. Mr. Biden was at 280 last week. He was way higher than that during the summer, and now it's getting closer and closer. And today we're at 270 for Mr. Biden, so it would be pretty much a toss-up. And the worst case scenario for the markets and I would say for democracy as a whole, is that if you have Mr. Biden win by a very small margin, and you have Mr. Trump with the style that he has, you like him or you don't, it's up to you. But the style that he has, he would be, and he's warning us that he will be contesting this election. And if we go to the Supreme Court, and until January, we don't even know who won the election and who's going to be president. And we know that it would be Mrs. Pelosi from the Congress that would be interim president for a while. So uncertainty for the markets never good. So if you have a victory by Mr. Biden with a very small margin, you could be in for quite a saga, which would be bringing volatility to the market. And also, if we do have a victory by Mr. Biden, we can see the unwind of the tax reform by Mr. Trump from late 2017 was quite a tailwind for the market. Mr. Biden is not shying away from his opinion that we should unwind that in the US and raise corporate taxes. So it was such a good tailwind for the economy and for the markets that if we unwind that, of course, it's a headwind. And in fact, Mr. Biden's proposed tax plan, if you look at corporate tax, corporate tax, it would be higher. It will be back to where it was before. Income and payroll tax hiked pretty high. Small business taxes, capital gains and dividend tax, estate carryovers, so all over the map, higher taxes. And I did my homework before. This guy here, his name is George Wallace. So he was an independent candidate in '68 when Mr. Nixon was actually elected. So he finished third, and he was arguing for very strong tax increases in the first year and percentage of GDP that was 174%. He didn't win. Mr. Biden, with his proposition, he would be number two at 1.53%. So that would be quite an increase in taxes in the US. So this is the risk that investors are seeing: higher corporate taxes and a headwind for the economy with more taxes from Mr. Biden. So this is the real issue with for the markets with the election coming in an increase in taxes from the Democrats. So just mentioned a few. So I will be taking questions after that. So this is kind of my introduction. Now maybe over to Spencer with the portfolios, and I'll be available to answer any question that you might have.
Thank you, Sebastian. So IA Clarington, which I work for, partners with advisors like Corey and Mike. And one of our best suites is a solution called the IA Wealth Managed Portfolios. And Sebastian, if you could turn to the next slide. IA Wealth Managed Portfolios are diversified for client target risk profiles. And so we have 5 customized portfolios here that are tailored to individual investor risk tolerances from conservative to high growth with different combinations of stocks and bonds. And we heard from Sebastian saying that this environment is very tricky for fixed income. So we've also adjusted it for today's environment as well, taking into account all 5 different levels of risk tolerances. And if you could pass that to the next slide. So this reviews how we've actually decreased our equity exposure, but also our mix of management and styles of, as Sebastian said, different styles of equity and different styles of bonds allow us to have better potential outcomes for today's environment. Next slide as well. So here is a summary of our enhancements. About a year ago, we decided to really focus on, what the changes were happening to this market. And we realized interest rates are really low. We realized that growth investments relative to value investments, which are expensive stocks relative to cheap stocks, were performing really well because of low interest rates. So we introduced some of the best third-party managers outside of our company into the portfolios. And those 5 are Dynamic Funds, Fidelity Investments, Mackenzie Investments, Manulife Investments, and PIMCO. Next slide as well. And so with this suite of funds and our own in-house managers, we have a diverse array of outcome-focused investing that will help the conservative investor or the high growth investor. And when you put it all together, we combine things like ETFs, individual securities, and bonds to create not only a return profile that we try to use with advisors like Corey and Mike to basically have a plan for your retirement. And so I would speak to Mike and Corey about what that plan is, and this may be part of it or the whole thing or something altogether. So speak to your advisor, and that's how you get great advice. Next slide, please. And so I'll maybe toss it over to Sebastian, but these portfolios are managed by our chief economist, Clement Gignac, who is business partners with Sebastian. And so maybe, Sebastian, you can speak to Clement and your team's process and what that looks like today. It looks like you're on mute, Sebastian, if you would mind unmuting, please.
Sure, it's always better to unmute yourself when you're speaking. So, all right. So Clement has been managing these portfolios for many years, and I have been co-managing the portfolios with him for a few years unofficially. Now officially we are listed as co-managers. So Clement is the chief economist at IA. He used to be with the National Bank before as their chief economist. So in Quebec, he's very well known on TV. He's always on TV and on radio, and in Canada also presence on BNN. So he has 30 years of experience, and he's been a great mentor to me. We managed together about now $10 billion if you take into account also the pension funds that we manage. So pension, it's not clients' money, it's pension fund for the IA employees. So we've been working together for 8 years, going on to 9 soon. So time flies. if just to go to the process. So we are economists. So Clément is an economist, and I am an economist too. We do everything as economists, formulating worldviews on the markets and the global economy, where it's going. And then we make asset allocation calls, and we allocate the money to in-house portfolio managers, external portfolio managers, and we also use ETFs and options and all of the tools that we have at our disposal. Make sure that we put the right level of risk in the portfolio and to remove risk when time is right. So we use all of the tools that we have. So we start with an overview of the economy. So internal, external research, we have access to the brightest economists around the world that are giving us a service with their views. So we use that, and we use our own views that we build. So we look at economic growth, we look at currencies, we look at commodities, we look at geopolitics, and then so this is the economy part. We also look at the capital markets. So how is the valuation? How do we assess the valuation of each of the markets relative to their history, relative to one another? What is the sentiment in the market? If the sentiment is too bearish, I remember that there's a good quote from Howard Marks that I like to use, that every great investment was born out of insecurity or of doubt or of fear. So usually when people are too scared or too bearish, like in late March, it was a great time to jump into the market. And when everyone is too excited, there's so much exuberance, usually it's a good time to start to take the opposite view. So market sentiment is very important. Fund flows, we know from the data from the banks around the world where money is going to. So we know that even though we see the stock market push higher, there's not that much money going into equities. It's the way that people are playing the stock market with options and some specific names like Apple and Tesla that are pushing the stock market higher and higher, but the average stock is not so in demand. So there's lots of room for these companies to grow. So fund flows is very important for us in our process. We look at the momentum because it's important to follow momentum up to a limit, but usually momentum is your friend. And when there's too much momentum, this is how you know that at some point it's time to start taking some profits. And sector rotation, so where money is going from the value to the growth to the sectors. So this is exactly what we need to follow. And based on that, we make a decision on asset classes. We also make decisions on currencies. So should we hedge the Canadian dollar versus the US dollar and versus the euro or not? So we make all of these decisions. And when we decide, should we send money more to Canadian equities? And for Canadian equities, should we send it to this manager or that manager or an ETF, depending on the style of everyone? So there's a lot of things to be watching, but we have a system that lots of tools that we use to make the best decisions. So we have complex markets. Markets are moving faster than ever. I'm always telling the story about how the market gave us the fastest correction ever, and this is the fastest rebound ever, and this is the fastest recovery from a bear market ever. And the bear market that we had in March was the fastest bear market ever. So it's always the fastest something ever now. So you need to be on top of these things and to have the right tools, be able to act at the right time. So active asset allocation. So we act and we dare to act when it's time. Active due diligence. We know everyone. Every of the portfolio managers that are in the portfolio, we know how their style is evolving, and when it's time to send money to one manager to take money out of another manager's funds. So we follow that. Active foreign currency management. As I mentioned, we have strong views on the Canadian dollar, and we could be hedging one day and be hedging the next if the reason that we did a trade starts to reverse. So we won't be afraid to do that. And active rebalancing, so we need to keep them at their target, their risk level. So if you are an investor and you say I'm more conservative, then we want to make sure that the solution that you bought is in line with the profile that you have at all times. So we're very active on that too. So I think that sums up. Now there's this thing, just to give you an idea, every quarter we produce these kinds of tables to show the investors how our views change. So this is a good example. So this is for Q3. as you can see, maybe here, if you'd see my cursor, the US equities, we were overweight in the second quarter and we shifted to an underweight because this is exactly what I mentioned. The US stock market was a very good place to be invested in, but probably it went too fast, too high. And now with the election risks coming in, we would rather take money out of the US, put it underweight, and we were neutral, international, and emerging market and push them to an overweight because we're seeing some relative value there. So it's a good idea to go where value is and to make sure that you don't be exposed to too much volatility by overstaying your welcome in a winning trade. We hiked also the investment grade corporate bonds. The good companies out there, their credit is doing quite well. So, and the central banks are there to support the credit market. So, wanted to have more exposure to that. And we did have an overweight to cash, and we brought it back to a neutral through our investment in investment grade. So, you don't want to be carrying too much cash around. When we think about the markets, we tend to think about the stock market, but it's not just the stock market. There are some opportunities elsewhere, and we thought it was a better idea to be in corporate credit than in cash. So we rose that in the Q3. So this is the kind of report that you can see every quarter from us. So Spencer, I think it's back to you.
Yes. So just in summary, IA Wealth Managed portfolios are a choice across 5 broadly diversified multi-asset portfolios. It is a one-ticket diversification tool aligned to your individual risk profile. And we're using active management from security selection. We're tactical in the market to move in and out as we see fit. And we especially manage foreign currency exposure because once you get outside of Canada, you're also dealing with currencies from around the world, and that can affect the value of your investments as well. So with that, we also have an investment specialist like Sebastian and Clement with broad reach and diversity within our company. And we've hired some of the best managers in our view from around North America to take part in these portfolios as well. We have daily portfolio monitoring with ongoing rebalancing to maintain these designated target risk levels that are tailored to your individual situation. And then we do in-depth reporting with these quarterly commentaries, portfolio analytics, and we even have personalized client statements as well. And so definitely talk to Corey or Mike and see how that fits into your financial picture. But certainly we want to get into the fun part of Q&A, and I will open it up. There is a chat box below here where you can ask questions. I maybe will start off with one that is important to me as a new resident of Ottawa. Sebastian, how will low interest rates continue? Will they continue? And how does that impact Canadian real estate?
Yeah, and low interest rates will continue, as I mentioned, and the central banks are telling us until at least 2023, but I would be willing to bet that probably it will be in 2024, 2025 before the central bank, so Bank of Canada and the Fed start hiking interest rates. So if you all remember the years of 2008 to 2013, 14, where mortgage rates were really, really low. At some point for my mortgage, I had, I think, 1.25% for a 5-year fixed. So there was a window there when rates were really cheap. So, of course, this will be helping residential real estate. So you have this tailwind that's going to be helping, and this real estate is important for the economy because typically when you buy a house or you move from one house to another, or you're a young couple and you buy a house and you start your family, this will come with the purchase of furniture, and there's a lot of trickle down effect in the economy from that. So that's a good thing for GDP. So of course there will always be some risks, and we will still be talking about household debt in 2025, 2026. So this is a discussion for later, but this will be helping. In commercial real estate, we're starting to see many businesses being under pressure. In Canada, it's better than in the US because we did manage so far the COVID better. In the US, we're seeing less stress on businesses, and malls are not as hurt as they are in the States. but it's hard to be bullish on commercial real estate in Canada. Business model will be changing for many businesses more towards the web. Any restaurants or proximity services will be hurting too for a while. So expect a cycle of some going out of business and then new businesses having to form to replace those. So we could be in for a few tough years. But for residential real estate, we have some pent-up demand also, but low rates are causing the data like we see now in Toronto and in Vancouver. We're seeing record growth in the number of sales, record absolute sales in the GTA, and record average prices of sales in the GTA too, all time. So we are seeing the effect of low rates, and this will carry on for a while.
Thanks, Sebastian. Question, private message I got. What are your thoughts on Shopify and other short-term performance stories like gold, cannabis, and Bitcoin?
Well, I'll start with Shopify. We always speak about the concentration of the big five in the US, so Apple, Facebook, Microsoft, Amazon, and Google or Alphabet. But in Canada, Shopify is starting to be quite large for the TSX, but it has the business model of the future. So it's hard to tell when it's gonna end. And they make a lot of cash, just like Apple does, and just like Facebook does. So when there's not that many opportunities around, usually these kind of stocks are well in demand. So it's always hard to tell when you're in a bubble and when it's about to burst. I would not call it a bubble yet for Shopify, but it is not cheap, and it could be going on still for a while. But you never know with a single stock. Anything can happen. You never know with that. Cannabis, it was a very interesting trade for a while. Now, it was interesting when investment professionals like us were not really integrating that in portfolios because it was too risky. That was when it was interesting, to be honest, because you know that at some point professionals will have to jump in and put that into funds, into mutual funds and seg funds. So at some point, you know that the big bucks will be coming and these stocks will be performing very well. So we did have that phase. Now all of the portfolio managers out there have the right names, their exposure to cannabis, so it's becoming just one other stock, one other sector among the others, and now it's supply and demand. So I won't speculate. I don't know what's the demand for pot these days. I'm 40 years old now, so I don't know about that. But we are. It's just another sector. So I would say that the easy part is behind us. But there was always this joke that I like to tell for many years when people ask me. This is the first time I'm actually giving an honest answer about pot stocks, because for a few years when people were asking me that, I was always saying, well, I'm not a stock picker. But what I do know is that with the pot stocks, you need to buy high and sell high. So that was my kind of joke that I did with the audiences. So, but now more seriously, it's I don't see that as being an outperformer for any reasons. Bitcoin, I think the mania is behind us by a few years. Now it's getting. It's in the consolidation phase, in the sense that central banks are looking at it seriously and saying, well, probably cryptocurrencies will be a thing someday. But now it's not as exciting as it once was. So Bitcoin is only if you want to speculate in the short term. I won't go deeper than that. But gold did have a very good run recently for very good reasons. When you have geopolitical risks, gold is an important asset class to own. When interest rates are very low, and remember that I said that interest rates will be low for many years, well, gold is a very good asset class to hold then. So now we're seeing a bit of a profit taking in gold, but we still think that by the end of, let's say, 2021, gold now is below 1900. It will be between 250 and 3000 in 2,500 and 3,000 by the end of 2021, most likely. And all of the reasons are there for that. Following the recession in 2008, gold gained over 100% in a few years. And there's no reason to think that following this recession, we won't see also such gains for gold. So we remain quite bullish gold, and if we think it's good to hold it in the portfolio because it gives you some diversification and some potential for some strong gains. So if you can be patient, it's a good asset to own.
And what would be the weight for across the average for the portfolios in gold?
In the portfolios that we manage, like the managed portfolios that we discussed, between 2 and 5% of those portfolios are gold, and it was not always the case. It's been the case for a few years now, but we going forward, you can expect to still find between 2 and 5% gold in there. So if you want a balanced portfolio, but you want some gold, well, these funds will give you both.
Certainly, Canada is a story of stocks like this, and it's herd-like mentality, and a lot of excitement, and then a lot of letdown. So, having not being in all your eggs in one basket certainly prevents that risk, and looking at your portfolio from a holistic perspective like Sebastian and his team do certainly help us. I will open it up for one last line of questioning. I'll leave a couple moments here for people to type, but if not, we will wrap up the call. I want to thank everyone who joined us today, and certainly Corey Sparling and Mike Antosic for having us as a partner. Additionally, if you have any questions, feel free to reach out directly to Corey or Mike, and we'll be happy to field them. Sebastian, again, thank you for your time and from joining us from Quebec City.
Sure, it's always a pleasure.
A wonderful night. We'll end the call here. Thank you again, and take care.
All right. Thank you.
Bye. Everyone. Take care.